Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Tuesday, April 24th. Welcome to the podcast. Hope you had a good weekend. Mine was nice, as usual, a lot of family time, and a bit different this time, though, is the weather gods. They finally popped their heads out. And for the first time all year, we had a nice spring. I was able to sit out on the crossfield on Sunday in a t-shirt. I didn't have to sit out there in my parka and my gloves and my scarf and my feet freezing. So not to mention my kids and all the kids playing, but hey. So it was a nice weekend weather-wise. It was great. I was thankful for that. My Mets still in first place, but I got to tell you, they're showing signs of being the Mets. Now, my roots are Italian. You may or may not have known that. You probably can't tell that by my last name, but I was raised in a house by my grandparents, and my grandfather's name was DeMarco, and my grandmother was Di Lorenzo. And so they raised me, and that's my roots. My other half is a little bit of Polish, a little bit of Russian. But that's my identity. And in the house I grew up in, when something would cause you anxiety, we would say that it gives you agita. The Mets are starting to give me agita. It's that heartburn feeling, that burning in the throat, right? Oh, you give me agita. That's where my Mets are. You don't want to hear it. You'll hear plenty from me throughout the year about the Mets. NHL playoffs, they're in full swing. I'm not going to bore you, I know. I get some actually mixed commentary. Like a lot of people like the sports stuff, some don't. But, during NHL playoff season, the greatest sports spectacle on earth, I have to mention it. Hockey's been fantastic. Tough to get up in the morning with these late night games, but the show must go on and work work is there, so you got to do it. But when you're up till 1, 2 in the morning, it's never easy. But the trade-off is watching great hockey, so it's all good. So rest of the weekend, caught up with some reading. I answered some emails. Feel better when I get that off my plate, although I have still some emails in backlog. So if you've sent in, I get a lot of emails for the podcast from people listening in. I'm getting to you. I try and answer everyone, and I have a few left, so I am getting there. But so anyway, that was the weekend. Now some housekeeping issues. So I get a lot of comments in email and Twitter saying you enjoy the podcast, you really find them educational, and that's why I do them. So that makes it all worth it. And the common theme seems to be that you like the depth of the subject matter and you're finding it as a real useful educational tool. And again, that's my whole purpose. I have had a few, mainly on Twitter, not so much in emails, but people saying, hey, it's just too damn long. Shorten them. Okay. So a couple of things. And I love those suggestions. It's great. First thing is I get it. I've taken it under advisement. And I've come down on the side of, if it's too long, I apologize. The majority of listeners who write in or tweet say they're happy with the length. It's what I'm trying to give is more than you get in the mainstream, right? It might be a week. There's not a format to the show, but it might be a week where I think I have something to say that could be really educational or insightful or thoughtful that might help you as an individual investor. And I might take some more time on the front end talking about it, or I might have a listener, a guest that you're not going to get elsewhere, that I think is really, really worth listening to and drilling down and picking their brain. And where do you see these on a 3-minute podcast or a 3-minute CNBC piece, or there are other podcasts, and I always say that there are hundreds and hundreds of financial and stock podcasts, and I get mine might be too long, and you also have a choice to go to the Curzio Research website where you can download the transcript. But I'm doing this to provide insights from my career as a professional investor, and not only some of the things that I've gotten right, but I've gotten a lot wrong too. So I could share you some of those mistakes I've learned along the way. So I'm not under time constraints. I'm not doing this for ratings. I don't get paid to do this. This is all my time, and I'm thrilled to do it. It's free. You could listen. You could not listen. I hope you do listen, because I hope you'll come away with it. But so far the scales are tilting heavily in favor of keeping it around the same length it is. Somebody told me you could do also 1.5 speed, and that might make it go faster. But every week is going to be different lengths. Some could be shorter, some could be longer. But I don't have an hourglass and an alarm telling me when to go off. So anyway, that's where we're coming out on that. This week's very busy in the market. I think more than a third of the S&P 500 companies are going to report their quarterly results, which this should make it probably the busiest week of the first quarter earnings season. Now, I record this on Monday, so after the close tonight, Alphabet and Google is going to report. I think coming up on Thursday, we've got Facebook, Qualcomm, Amazon, Microsoft, Intel. So the big tech names, the names that have really carried a big portion of the market for a while. And then we have some other non-tech names. You've got Caterpillar and 3M and Coke and Boeing. The UPS is coming up this week. I like to listen to UPS, a good read on the economy and what they're saying. Got ExxonMobil out there. Chevron's reporting on Friday. But let's talk a little bit about what that means. What does earnings season mean? And I do this for those, if you're a professional investor, you might get the drill, and this might not be news to you. But for an individual investor, you hear earnings season is in full force. Earnings season coming up. So let's talk about that. Companies report earnings. I like to read the transcripts or listen to earnings calls of just a smattering of companies from different walks of life. They do different things. They're manufacturers, they're service companies. It gives me a sense for what's going on in the world, what's going on in the country. I kind of get a sense for sales growth, what that looks like, what's happening on the cost side. Or what are the cost pressure points? Where are they seeing easing? Is it in the transportation side? Is it in the healthcare spending? Because all that stuff goes into impacting margins and earnings. And so I like to read transcripts, listen to earnings calls more than just, I don't find it very helpful for me to read a recap in the newspaper or on the web. That's not that helpful. And you'll recall to reading newspapers versus getting my info on the web. That tactile feel, as I said. But so let me give you a little bit of a playbook, and it's in no way all encompassing. It is in no way everything you should be looking for. But let me put you in my mind as to what I'm looking for when I read the transcripts. So I listen to the call. So I start out with this. The basic premise is, and remember, I am a born and raised short seller in the business. So, and I'm a skeptic. So that's you got to remember where it's coming from, but you don't have to be a short seller to be skeptical. But I do think to be a good investor, you need to be skeptical so you don't get run over because you fell for the tulips and you wanted to pay the higher price for that tulip. So I think that you need to come to investing with a degree of skepticism. Now, with that in mind, always remember that by the time somebody is at the CEO level or the CFO level of a medium to big size corporation, even the smaller ones, they're polished. They are extremely polished. Imagine you rose to the CEO level of a 5, 10, 15,000, 50,000 employee company. You didn't get there by not being skilled at both the political game of how to deliver a message, of how to get ahead, right? And what I've found over the years of meeting thousands of management teams is that they're in the business of making their company look like an ice cream sundae with a cherry on top. Very few do you find, until the horse has left the barn when something's gone wrong, do they bring out the warts? Do they tell you about the warts, right? So when I'm reading these transcripts or listening to an earnings call, I don't take what they say literally. I listen and I try and put it in context. And to do that, and I can't do it for everyone and I don't do it for everyone, but you read a prior transcript, or two, right? I'm not going to go back years, but if it's something that's interesting me, when you're looking at a sector or a stock that interests you, don't look at it just in the moment. Go back and get a feel, get a rhythm, get a flavor of the tone and tenor of the prior conference calls, and look to see what they're saying. Are they saying a lot to say nothing? Is it full of gobbledygook and corporate speak? Project XYZ is our turnaround plan, and everyone has projects. Everyone has. The more they say in the beginning, the more they throw the corporate speak at you, and the less meat they're giving you. That always makes me a little bit leery. So I'm looking. Was it a tough quarter? But I'm looking for the guidance they give, right? So one of the things you'll see is a company will report earnings, and they blew out earnings. And the headlines are just absurd. And you might look and the stock could be down. Why? Because it's not about what the company did today. It's about what did they guide to, right? What are the expectations in the future? Because the stock is likely reflecting that, what people were expecting today. So it beat expectations. Did it raise expectations? Did it keep expectations in the future the same? Or did it lower, right? So one of the things I like to look for, excuse me, is when the quarter is announced and the guidance is presented, I want to see how the sausage is made, right? Do they say price, volume, mix are going to do this, or sales growth is going to be this, or the expense side of the equation is going to be this? And one of the things I really like to look for, was it a tough quarter, but things are looking better in the second half? So let's say a company reported a quarter. It wasn't ideal. They might have made the number or missed it by a little bit. They come out and say, we are maintaining our full year guidance. Well, okay. So that means you're a little bit behind the eight ball already. So that means they're back end loading their numbers. Now, oftentimes what I find is that's double speak for, yeah, we're really not sure, but we hope it turns around. We hope it was a one quarter blip. Back-end loaded numbers are something you need to be particularly pay attention to and be skeptical of. And right, you need to look at what that guidance is comprised of. Does it require the company to reverse a recent trend? So if they put up a first quarter and they were to back-end load the numbers, for them to make those future numbers, does it require, let's make it up, a company's put up 6% sales growth 3 quarters ago, 4% 2 quarters ago, 2% this quarter ago, yet to make those sales, to make the earnings number, the sales need to be +5 or +7. How is that trend going to change? And you have to ask yourself why. What's going to cause that to change? What needs to happen for that trend to reverse, right? Things that are in motion tend to stay in motion. So it could be they've been making their quarters and they just happen to either make or miss this quarter, but they're hoping for the best, right? But remember, big companies don't change on a dime. These trends tend to continue for a while. So you need to think about that. And so, okay, well, maybe they're guiding to that sales growth that's going to reverse. Now you have to ask yourself, because you're an individual investor at home, right? And you're putting your own capital to work. What's it comprised of? If the company is supposed to grow 5% next quarter, how much of that is coming from raising prices? How much of that is coming from increasing volumes? And how much of that is coming from selling more of higher price products? Price volume mix, right? That's how you think about sales growth. So when you think about that, let's just walk through the mechanics of that. When I raise the price on something, I'm likely going to have a higher profit from that. I send a salesperson out, or I send an email and I take price, and voila, there you go. So 1 percentage point increase, there's a certain amount that flows through to the bottom line. Now, if I have volume, if I'm going to get my pricing from more volume, that means I'm selling more of something. Well, I need to order the raw materials. I need to buy the pallets. I need to send it out in transportation. There's more involved, right? So a point of volume is typically less profitable than a point of price. And then on the mix standpoint, is there something new? Do they have a new product cycle that has a higher selling point, a higher profit margin, right? So it's not enough just to look at the trend. You have to understand the composition of the growth or the decline in growth that they're talking about. Then you have to ask yourself, are competitors experiencing the same? Let me keep an eye on the other competitors in the space, and this quarter seemed to be similar to the company that I'm looking at. And if not, why? Think about pricing power. When we talk about they're going to take a point of price, can they? Or do they hope to? What's the environment they're selling into? If you're a consumer staples company and you're selling household products and you need to put up 3.5% growth and volumes are challenged, but you say we'll make it up on price, is your customer, the big box retailer, going to let you do that? Right. So you as an investor need to be asking yourself those questions. On the cost side, you need to think about, and I see this a lot in deeply cyclical industries. Well, it could be dairy processing, it could be tires, it could be anything consumer oriented that has a lot of input costs that have a lot of variability to them. So you need to ask yourself, is something occurring in the cost of goods sold that has been a temporary boost to margins? Have input costs been down tremendously? Are they likely to continue doing so? Right? Whether it's milk or it's rubber or it's wheat, it's corn, whatever it is, you can look it up. And what's the trend been in that? And where is the company? Do they hedge their input costs? Right? If input costs that have been a big help to them, a big tailwind to them in the past, if they were to move 5% or 10%, what would that do to the company's earnings? These are questions you need to be asking yourself, right? Because cyclical companies that make cyclical products, if they're using cyclical raw materials, you have to pay attention into the raw materials because that goes into the cost of goods sold. Some of these input costs are so volatile that the management teams may or may not be able to hedge it. They may or may not be able to have an edge, if you will, on where the pricing is going. And so if you look at that guidance and you look at the input costs that have been down for years and they're expecting it to stay down, why? Always ask why. Why is that happening? Is there something that could cause that to change? You need to look at, is the company gaining or losing market share? If they've been losing market share, do they need to increase spending to become more competitive? Have they cut back on prior years' selling general administrative expenses? If it's a consumer company, have they been cutting back on advertising and promotional expenses? Has it finally caught up to them? They may have been beating and raising numbers because they've been cutting out elsewhere. So you just need to be aware of that. Is there a competitor coming out with a new product that this company doesn't have? So they're going to need to entice people to buy their product. And that, of course, that's going to hurt margins. When you're thinking about guidance, you want to think about the overall environment. Do they ship a lot of stuff? If they ship a lot of stuff, what percentage of costs are transportation costs? How variable is that? What's been the volatility in that? Have they factored into that? You want to think about the healthcare costs. What's going on in healthcare? Right? That's another big issue for a lot of companies. So it's not so much as just looking at the numbers. And you want to understand, does the guidance include lower capital spending on maintenance type items? Right? That's a way companies can save some money, is they put off maintenance expenses. And if it's a big manufacturer, you gotta look at that. Right? And how do you look at that? You pull up the free sites and you could look at the different years of what the expenses were. You can go to the filings. But again, a lot of work, but you're an investor investing your own money. Is it worth it? I think it is to do that. And again, if you're coming out with a new product, does it require really heavy spending to get that? What's the return on that investment? And then I think about, I'm looking at what the cash flows look like. What does cash flow for this quarter? How does it compare to the year over year and the last quarter? What's the trend been in that? What's the free cash flow? Right? So there's operating cash flow and then the capital expenditures to run the business. And then what's left is free cash flow. What does that look like? What's the trends been? Is free cash flow accelerating while capital expenditures are decelerating? Well, maybe they're not reinvesting in new property, plant, and equipment. Maybe things aren't as good as they appear. Take a look at the debt. How much debt does the company have? When is it coming due? How are they going to pay for it? Here's one. A lot of companies are tied to LIBOR, floating rate. LIBOR's doubled in the last year. What's the interest expense on their debt that they pay every year? And it's floating. How much does it readjust up? What's that cost in interest? How much does that affect earnings? What if they have debt coming due? Know what debt is coming due. Know how to plan on paying it. Do they have too much debt? Is the net debt versus to the cash flow that they have too onerous? Right? You need to ask yourself that. Can they pay their interest expenses? When the debt resets, how are they going to pay for that? How are they going to issue new debt? Is it going to come out of credit lines? I mean, things you need to be thinking about. What I'm trying to impress upon you is, don't take the company's word for it. They can get there many ways. Look, most or nearly all of the companies are run by honest, decent people, but they're in the business of putting a cherry on top. So these are the type of questions you need to be asking. You need to peel that onion back. And if you're investing your own capital, putting in your own time, I think it's well worth your time to do it. Listen on the conference call, whether you listen or read the transcript, pay attention to how they answer tough questions. Do they get irritated? Do they come out and blame short sellers? Big red flag. Ignore. Note to management teams: shut up and run your business. Ignore the short sellers. They're not the one. They're not the reasons. Almost all short sellers gravitate towards your stock because there's something fundamentally going wrong. For me, when I see blaming the shorts, that makes me dig in even more and do more work. Pay attention to what sell-side analyst is asking the tough questions. Have they asked tough questions before? Look back a few transcripts and see if they have. Does the analyst's tone seem irritated? All of these things go into what the future expectations, right? If you get the sense that the analysts who have been, for the most part, the vast majority of them, taking management's guidance and word as though it's fact, if they feel as though they were burned, they're going to become more skeptical. Right? And as I said earlier, be very leery of cyclical companies that have had a very good run. Look back over the years, see what their peak earnings and margins have been. Are the expectations for it to go higher? Why? How do they get there? Things go up, things go down. Are the input costs supposed to stay really low? Do they have more pricing power? That's where, you tend to see people get really excited on deeply cyclical industries that are breaking out to high earnings. It looks beautiful on the chart. You're going to get the chart guy said breaking out to new highs until it doesn't, and you're left holding it back. So those are some things I think you should focus on as we get into the earnings season. I think it takes time, it takes effort, but you're already showing that you're listening to me for an hour and a half or an hour if you've cut me off. But it seems like you have an interest. I think you might want to take the time to do. The other thing I want to talk about is generalist versus expert. I get a lot of this. I am often told, or I hear a lot, I speak a lot publicly about uranium. And I see if I'm been quoted somewhere, or I'm not quoted, but they pulled a quote from me somewhere, and they'll typically say, uranium mining expert Mike Alkin. I'm not a uranium expert. I want to emphasize that. I am not an expert of anything until I am focused on it and drill down. I find often that the word expert gets pushed around quite a bit, and it often doesn't apply to many people in many industries. But there are some people who specialize in something. And when it comes to investing, I find that being a generalist is such a great advantage to being a specialist or an expert. Why? Because of human nature, cycles. I was taught that in the investment business, history doesn't repeat, but it often rhymes. Yet it seems quite often people forget that. And when you're looking at businesses that are cyclical in nature, at the troughs, people are very dour and they forget all the good things that could come. And at the peaks, they adopt the narrative that good times are here to stay. When in reality, if you look back over cycles, they cycle. But human nature is such that people tend to adopt the narrative. It's easier. So when you're a generalist, you come at something with a fresh set of eyes. Now, what am I expert at? If I had to apply the term expert to me, which I don't think I'm expert at anything, I would say that I'm a sophisticated reader of financial statements and the markets. I would say that I am good at knowing what to look for, right? There's a playbook that I use. I gave you a little piece of it with some of those questions, but it goes much further. But there are things that I look for. I tend to like to focus on more supply-demand driven industries, meaning cyclical, but I venture outside that once in a while. But there's a playbook that I apply that focuses on the fundamentals of the income statement that I just talked about, the cash flow statements, the balance sheets, the trends, the ratios that I'm looking at, right? And then if it's a new industry, well, if you're a pretty learned person, if you're a bright person, you should be able to understand what drives the fundamentals of an industry. Once you start reading and talking to people about it, what are the supply drivers? What are the demand drivers? What are the economics of supply, the economics of demand, right? And then once you get there, now you can apply that to different industries, right? So I'm known as a uranium, like I said, a uranium expert. I'm not a nuclear engineer. I'm not a uranium mining expert. I know what I know, and I know what I don't know. I am not a geologist. I am not a mining engineer. When I'm looking at the uranium mining industry, I tend to, if I'm looking at a more of an exploration company, well, I'm going to be talking to people who can get me smart on exploration. And the same thing with mining. I'm going to find people that can educate me as to what I need to know. Am I an expert on understanding sources of supply, demand, modeling them out? I think I'm pretty good at that. But we're coming into earnings season. I bring this all up because we're coming into earnings season, and what you're going to see is people appearing on TV and newsletter writers and other people and saying, "I'm expert at this," or they get introduced as the expert. Oftentimes, if you're spending all your time in this one industry, they may not be an expert. They call me the uranium expert. I've been really focused on uranium for 2 years now. I understand supply and demand drivers probably as well as anyone. Could I be missing stuff? Absolutely. Do I think I am? I don't know. I hope not. But I'm always questioning myself. But I am not an expert in uranium, just like you might see people come across as experts in other things. So don't take their word as gospel. You watch a 30-second soundbite, a 1-minute soundbite. Know who they are, where they came from, understand the amount of work that they've put in, and also know that when you are considered a specialist or an expert, you've been in this industry, any industry you're looking at, especially the cyclical ones, you adopt the narrative. It's human nature. It's just human nature that people fall into the lull during good times and bad times to adopt that narrative, right? So I often get asked, well, what do you read? What financial books should I read? I've read them. I've read plenty of them, but I do other reading. I read about current events. I read about history. I read about books about popular culture. I'm reading magazines that might not have nothing to do with investing, that have might jog a thought. At the end of the day, what we're trying to do is judge and try and predict human behavior and wrap some numbers around it. That's what the markets are, right? So what I tend to see is that too many specialist managers, they're not focused on the broader picture. They can be definitely disconnected from the underlying reality of the world that they're in, that they're investing in. And there's another downside to specialism, right? It's arrogance that it instills in the people who practice it, because they think they know their area better than anyone else, and they assume that whoever's talking to them doesn't know anything, and that they have an edge on that. When in reality, they may have ignored all the other external factors that are taking place that's going to cause a change, and it's happening right underneath their nose. And I've seen it time and time again. I can't emphasize it enough. So, Don't fall into the lull of choosing stocks because there's an expert who told you to do so. Understand where they came from, understand the work that's went into it, If somebody came on and said, I'm a generalist, that's a breath of fresh air for me. So enough of that. I have a guest coming on today. He writes independent research. He's a newsletter writer. I read his stuff on uranium, and we started to talk a few times. And I thought he has some interesting viewpoints. He's a contrarian investor, which I am, and so we're going to talk about a couple of different contrarian sectors. And he comes to us from Nicaragua, which is where his home base is. Andrew Weekly, CEO and founder of Smith Weekly Research. Welcome to the podcast.
Hi, Michael. How are you?
Doing well. Thanks for taking the time. Just for our listeners, in case you hear a slight pause or a delay after I ask a question, Andrew's doing this from his home and office in Nicaragua, where he lives. And occasionally the internet might just have a little hiccup once in a while. But Andrew, I appreciate you joining. And you and I got to know each other recently, but you reached out to me. You talked about uranium. And it got me to spending more time looking at some of your work. And I always have a soft spot for a fellow contrarian investor. And as I read more and more of your work, I saw how contrarian you are. So why don't you share with the listeners? Tell us about Smith Weekly. What do you do?
Absolutely. Well, we're a small investment research company. We have a very small group of folks here that basically cover three areas of the market. We have three newsletters that we write monthly. And the first one is Venture Investor, which is a natural resource newsletter. The second one is an options trading service. And the third is Investment Report, which is a contrarian and general macro newsletter. So anyway, we write those three on a monthly basis. And then we occasionally write reports that come out every now and then, probably about once a year. And it pretty much covers kind of key things that we see important, and also for other folks that might want to take a look, specifically areas like the uranium space, like you and I have discussed many times. And so that's kind of what we do. That's it. And I do everything from Nicaragua here in my office. And, of course, Nicaragua is a place in Central America there. And it's kind of a backwards socialist type country with a taste of capitalism. So that's pretty much what we're doing. And so far it's been fun.
So tell me about your contrarian style. Those who've been listening to the podcast certainly know that I am contrarian, and I have a variant perception. And if I could prove that variant perception, then I might have an investment, whether it be on the long side or short side. So how do you think about the world from of investing, and what, when something's going across your radar screen as a potential contrarian investment? Talk about the things that you look for, and some of the things that go into researching your ideas.
I think for us, the biggest thing that we look at, that I focus on, is kind of contrarian type plays that are based around cyclicality. And as most folks would probably know, cyclicality occurs in the big market, the credit cycle. It happens often in natural resource spaces regarding supply and demand. And also in other places, there's lots of cyclicality that happens over a span of time. And most of that time, people can't have the patience for, or maybe they can generate the patience for that. However, most folks, can barely hold a trade over a weekend. But I would say the real solid value that we look at is stuff that plays out over multiple years, and stuff that people absolutely just despise. And I think the easiest things to discuss would the big elephant in the room right now is the uranium space. That's one that really stands out to us. There are some others that stand out to us as well in the natural resource sector in general, and then also in the oil space as well. So those are kind of the areas we look at. And then once we've had a good idea that most people just absolutely don't like the space, the economics are not working in the space, and people are having bankruptcies and closing their doors, and mergers are happening, and cheap takeovers are occurring in the space, we tend to, when everything lines up in that direction, we tend to take a harder look. And then, of course, we start looking at individual companies and kind of get an understanding of the space from there, and then kind of identify the best of the best within that space, and then find a few investment vehicles that we can use to recommend where people have a 3 to 5 year outlook.
It's similar to the approach that I take. And I think, being a generalist as you are, as am I think it gives the generalist a big advantage to look at especially these deeply cyclical industries where you have people who have developed an expertise, whether it be from the mining side or the geological side or the manufacturing side, if you're thinking about something, let's say autos. And then it works its way into the investment side. When you look at the same thing over and over and you're mired in whether it's a really good market or a bad market, you tend to take on the persona and narrative. So especially I've found at really deep troughs, people who are ingrained in it and show up every day at the office and they're getting pounded because they can't sell anything, or somebody who's been investing in the space because they can't sell it, or they can't get their stock to go up because it's been so long. Apathy sets in and the narrative kind of consumes them. And it's there, I've always found as a generalist, where you could come in and if you have a foundation on how to analyze a business, analyze a company or a group of companies, and you can apply that playbook, if you will, that it gives a great advantage. And no better place do you find that than in the deeply cyclical industries.
I agree, Mike. I think that folks often overlook it because they just don't have the patience to stick around. They don't have the patience to deal with the volatility. They just can't deal with the type of movements that these stocks have in any given day and so forth. I think that is a big hang up for people. And then also I just think that people have trouble seeing a 3 to 5 year outlook. But when you look at these cyclical industries, it's almost clear to look at the history of them, and you understand the fact that everybody's sold. It's completely exhausted. There's almost nobody left to sell at this point. The situation is of a case where people just all of a sudden, when the story turns and the supply and demand fundamentals turn, and it's an industry that's absolutely a necessity, then these things just kind of explode in terms of value. Everybody wants to get in, and there's just not enough liquidity, and of course things just go up substantially. And so I think that occurs with a lot of different spaces that people just don't seem to have time for, or they don't know about it because they've been inundated with mainstream stuff and investment ideas from the mainstream, which don't yield much of anything. And so I think it's a very interesting place that few people dare to venture.
Well, and you also said something interesting, 3 to 5 year time horizon. I think people often think when you say that, or if I say that, or I'm thinking about that, it doesn't mean I have to wait to see an increase in stock price 3 to 5 years out. And I'm curious as your view, my view, when I'm analyzing these deeply cyclicals, I'm looking at the fundamentals forward 3 to 5 years, and sometimes longer, depending on the industry I'm looking at. And I'm looking at supply and demand. But oftentimes, for that to occur, for the positives to occur, something needs to take place well ahead of time. And often it's those changes that are happening underneath the surface that kind of get looked at, these little production cuts, these little manufacturing cuts, little things that can be happening that one by one might not seem a lot, but then all of a sudden you wake up one day and investors take notice. So and stocks tend to discount the future. They start to move ahead of the cycle turn because they will anticipate it. Those who are doing the work anticipate it. So that 3 to 5 year time horizon doesn't mean the bell goes off at that certain time. It's just you need to know that things take time. And you're right. I mean, I find so often the one thing I always say, Andrew, that's interesting is people say compare your time as a professional investor to time as a versus what individual investors go through, and it's fascinating because the professional investor does not have the luxury of time. If they're running a hedge fund, they've got monthly reporting, they have institutional capital that's been allocated to them that has to report back to the people who allocated to them. There's layers of it, and it doesn't allow time for the story to play out. And if you're a mutual fund, every day you're mark to market. People can see what your performance is. So people get into the business of performance chasing. And I always say when everyone's doing it, good luck when it turns. And when you're doing these, looking at these deeply cyclical and contrarian type names, if you're managing your own money and you just don't need to mark yourself to market and worry about it every day, and you've appropriately sized it, and it's if you're wrong for a while, you can handle it, you can sleep well at night. It is such an advantage that the individual investor has.
Absolutely. I agree with you, Mike. Just to pick on ourselves here at Smith Weekly Research, we've underperformed the market for a couple of years. If you take all of our newsletters combined and you add up all the results, I'm going to step out and say that we are underperforming. However, I contend that our performance will be substantial, outperforming in the future in a big way. And we've kind of got egg on our face right now, and a lot of folks are laughing. But I can tell you that will change, and it's not an if question. It's certainly a when question for us. When you get into these types of sectors, and when you finally hit that catalyst, things will move quite well. To put an understatement under it, I think that in the uranium space is a great example right now, where you have so many catalysts, but yet nothing has happened, and people can be negative about that, but that's fine, no problem. But when you get that final straw, things will start to move in a big way, and we've gotten so many of those lists that have accumulated and accrued with interest, so to speak. Where you will have a significant move going forward. So you're right, that there is that situation where it is buy the rumor, buy the news that's coming out, so to speak, in the rumor now, and that'll start to increase where you'll have in the future. I do. That's where we're at with a number of industries, not just uranium. There's a couple others.
Yeah, and you see that in uranium space. You see all of the little positive, whether it's weekly or monthly, the foundation that's being laid across the board, whether it's finally getting the production cuts that we needed, finally seeing the price of separative work units, the underfeeding in the secondary market declining to the point where it makes the enrichers think about producing more SWU, separative work unit. The name for that, SWU is the industry term, or whether it is seeing the U.S. administration become more friendly, seeing the trading arm of Kazatomprom open. And what happens is it's interesting, and I'm curious if you see this. I have a presence on Twitter, as do you, and you get what you find is if you don't put the mosaic of information and narrative together, right? So you can't just have information that's randomly out there in space, because you can take any one of these bullet points and run with it, especially in a down market. If something negative comes out, you could run with it. But when you have started from the bottom and you understand the mathematics of supply and demand, and you have modeled out the supply and demand, and you understand the economics of supply, what would cause somebody to stop producing, and this economics of secondary supply. When you start to see these dominoes start to fall one by one, it makes those little hiccups you may see along the way, over the last year, you've seen things come out. But if you step up above the room and look down and you say, my goodness, but look what's transpiring underneath. And it's like a powder keg, and it's human nature, it's human behavior, right? I always say people love the comfort of crowds, so it's easy to adopt that narrative. But if you just focus and put your head down one by one, like you said earlier, you've seen all these positive things start to occur. And yeah, we're seeing that in uranium. And people say to me, well, what are you looking for in uranium? Well, the first utility that comes out and signs a contract a hell of a lot higher than here. And oh, by the way, they need to come to the market, right? So all the noise that goes on, you got to avoid the noise and focus on what matters. We're going to spend. So how did you come to the uranium space? When did you come to it? How did you come to it? Thinking about it now, give some insights there.
Well, I think we were probably at the point when we looked at it, we were probably the rat in the corner. Where no one wanted to be. 2015 was when we officially got into the space with recommendations in our newsletters. We had launched in 2015, we had launched our natural resource letter, and we recommended a number of uranium businesses in there, which incidentally, we still have some of them today. And so that's when we first got into it. Now, prior to that, personally, I had kind of watched uranium from 2013 till 2015. And then had a few investments of my own in the space, which, of course, I was clobbered. And that helped me to understand what it's like to be on that side, because I really believe that is really important for folks. Trust me, if you don't know that now, you will fall out. But you need to be on that side of it. So we got that experience passed to us, and then from there, we didn't start doing deep research into it until 2015, and then we recommended a few names, and then, of course, 2016 was an initial and fake out in late 2016 in the market there, and then we published our first big report in 2017, of course. So I would say that would be, for us, probably 2015 is probably a good key date where we started digging into the sector. Now, how did we find out about it? Probably just various avenues. We didn't know anybody in the space at the time. We just, did some research on the internet and saw some different shows and interviews and conference info, and that's kind of where we started out finding out about it. Prior to that, I had no knowledge whatsoever of the nuclear industry prior to about 2013. Had no clue how it worked.
Yeah, I personally don't think that matters, because I think smart, intelligent people with an open mind and understanding how businesses work and how supply and demand works can approach any industry. The only industry I always say that I won't look at is biotech, early stage biotech, because even early in my career, I would look at some biotech companies in different phases of drug trials, and I realized that after I read 5 pages, I didn't understand a single word I was reading. So aside from that, especially in these out of favor, deeply cyclical industries. So what are you looking for now in the uranium space? What are you keeping your eye on?
Right now, we continue to refine our positions in individual companies. And then as far as catalysts going forward, I think people, it was a good news piece, I think. And, the words about Russia maybe holding up some support to the U.S. and so forth is hit the airwaves over the last couple of weeks. And I think that's a good story. I don't know what side to take on it. I've thought about both sides on that issue. I don't believe it'll be anything. I think it'll be a catalyst that adds to the story and the foundation, but I don't believe that there'll be a significant issue coming out of this yet. And we can talk about that later if you'd like. But to move on to answer your question, I think we need to look at Japanese restarts are going to be key. We've got to continue to get those going. There's got to keep moving. I think that's an important part. And then I think the next important part is the final straw that breaks in the long-term contract area with the utilities. I really think that'll be, and that might be part of the 232 petition. But when those long-term agreements start coming into place, I think that will be another key area that we really need. So Japanese restarts and then long-term offtakes. I think those are going to be, or supply agreements, those are going to be the two keys that'll really go. And I don't think we'll start seeing that probably till 2019, maybe even 2020. Yeah, that's what we're looking for. We're refining our positions, and we are still looking at some companies, but we're pretty much have taken our place with the companies that we like, and we've kind of just been sitting, waiting for better prices. If we can get prices 50% off at today's levels, I'm more than happy to have that opportunity.
No, I come at it a little bit differently than you do. So I look at Japan. for me is less important. And just, we both get to the same endpoint. I think we get there maybe a little bit differently. So for me, Japan is I think it's important, obviously, that you want to have the continued pace of restarts, and we're 7 or 8 right now coming back online. For me, the way I'm looking at it is I think the price of uranium kind of reflects $20 uranium kind of reflects that. And as I think about it, and I turn some of my more attention to the secondary market, where I spend time looking at the underfeeding and the impact that that's had, putting a lot of pounds into the market. And as I think about the underfeeding, I see that the cost of the separative work unit, if you were an enrichment plant, at one point you were able to get $150, $170 per separative work unit going back a handful of years, and today you're going to get about $39 for it. And I look to see the rate at which these expiring centrifuges are being replaced, because when they're not replacing them, you've got this excess capacity, and that's why they're underfeeding. And when that kind of retires and they don't replace it, that to me is indicative of less supply potentially coming into the market. So I focus on that. And for me, I'm looking at that when I look at the supply numbers, I just feel as though the squeeze we're seeing now from Kazatomprom that we're seeing, and then we see the obviously the Kazakhs had that the 10% cut is what I'm referencing to, and then we saw McArthur River come offline. And I think people think McArthur River comes back in 10 months' time. They said it's coming down in January of 2018. It will be on 10 months, and you're going to have that all those mid-teens millions of pounds come back into the market. And I don't think there's a prayer that they come back into the market unless the price of uranium is sitting at 40 or north of that. So I look at, like you, we get to the same endpoint. I think, when I look at the contracting market, I say, okay, we've got a third of the utilities needs by 2020 are uncovered. And if they want to cover those needs for uranium, they got to order 18, 24 months ahead of time. So, it's an interesting time. And to what you said earlier, I think is so interesting, the when, not ifs. And when you can eliminate the ifs and it's just the whens, and you can buy at the right price, tell you when I say right price, meaning sleep well at night, and you can handle some downside, because then the upside can be pretty dramatic. So how do you, when in your report, it's out there, I know you've posted on Twitter, you see, what's the name of the uranium report?
It's Nuclear Energy, Best Investment of the Decade. So it's out there on our website. We have it on there. And of course, we do have it on Amazon as both a Kindle ebook and also a paperback book that you can buy. Of course, we'd rather have people buy it from us directly instead of Amazon, because they take almost everything. Yeah. But regardless of that, we do have it available for folks who want it. It's very, very, very inexpensive. And of course, for your readers, Mike, we're offering that up for free with that custom link that we provided you. But with your comments there, I do agree with just about everything you said. I think that people need to look at the trees, the individual trees that are in the forest, but at the same time, it's the forest that matters, and so they get the macro and the micro view. And I think that all those pieces are also critical, because, like you said, there is a severe bottleneck on the enrichment side, and there's a significant issue there. The secondary supply is waning off quite substantially. I think that's almost to an end now. Very, very little secondary supply, in my opinion, is coming on the market in terms of spot. And so I would say that those are all very key issues. And I think people need to see both the individual issues and then also the big picture as well. And then with McArthur River, I do believe that they might bring those folks back on and then lay them back off. That might be a good key strategy. But I agree. I don't think they're not coming back online for any reasonable purpose anytime soon. So that's my view on that. But I do believe these are all key parts, Mike, that will come together in the big puzzle.
Exactly. They're all pieces of the mosaic of information and fundamentals that are all improving. And like I said, Japan's important. I think it is. I think sometimes that, I remember looking at a lot of videos of guys in 2012 and 2013 and listening to people talking then. And it was all the Japanese restarts back then. And you say, okay, well, yeah, that made sense. And just kind of, time. When uranium was $7 and $60 and $50, when you get a commodity where the cost to produce it is 50 and the cost and you're selling it at 20, that math just doesn't work, right? So it's a very interesting time. There's another sector that I think I saw you write on that I like as well, that has been left for dead, similar to uranium, and I think offers some really potential asymmetry from a risk-reward standpoint. And that's the offshore drilling service companies who've really, really had a tough time in the last few years as oil got hammered. And why don't you talk about your view on that space? I know you just recently wrote something on it.
Right. Well, I think your guest 2 weeks ago, Chris, there, venture. Let's see. I want to say it's
Chris McIntosh.
Yeah. No, he hit on it great. I think there was discussion there, and I even think your discussion with Adam there also had a little touch on the shipping industry in the whole there. But yeah, we actually wrote something. We were as you put that out, we were actually just finishing up our notes on that piece on the offshore drilling side, and we have a bullish view on offshore drillers, your Transoceans, your Diamond Offshores, your ENSCOs. Those types of folks are probably going to survive quite well, and they're going to do very well going forward with oil prices back up. We see that the big oil majors, both the state-owned majors and also your standard publicly listed majors like Exxon and Shell and BP, will be attacking the offshore space yet again. And with some of the positive government actions there in the states, the Trump organization there, with their auctioning of offshore blocks is positive, of course, and I see that the attraction to those offshore areas, specifically the Gulf, is find major wells that have such capacity that the cost of operating them are very low, and you have reservoirs that last for a long time, and it just beats the pants, in my opinion, off your onshore oil plays. And so I believe there's a returned attraction to that area, and I think that folks are really going to go after that again. And of course, I think the sector probably got hit. The initial straw that took it down was probably BP's Macondo well in the Gulf when the Transocean rig there, but more or less, and they had it, and they were controlling that well, which everybody knows about that story. But I do believe that's where it started. But that well was a monster, and it was too bad that what happened. But that's where it kind of started. So it's kind of been in a kind of a negative territory for many years. And during that time, companies have struggled. They've gone bankrupt. They've reorganized, and also because of that, new builds were canceled. Old rigs, of course, continue to come off the market. And when you have a consolidation period where you have low daily contract rates for these rigs, everything just kind of compresses and just kind of dies off because they have a big upfront debt on new rigs and maintaining rigs, and then when the daily rates plummet, the folks start going out of business. And so that's kind of where we're at today, where we've had plummeting in rates for a long time. Companies have gone bankrupt this year, last year. There's been mergers and acquisitions occur. Daily rates are still quite low, but there's been such a consolidation in the space. There's obviously just recently the stocks are also quite a bit up higher off their lows. We see it as an uptrend at this point. I don't think we're going to see the lows again. So I think it's already starting. And the cool thing about this, Mike, is it's the oil space, and the oil space is incredible in size. It's very, very liquid. There's a lot of action that happens there. Things recover quicker. It's a very, very large liquid space, unlike the uranium space is very, very small. I think the total listed companies, public companies, make up almost the same market cap as Canopy Growth, which is a weed stock in Canada. So a single weed stock is larger than the uranium space combined, pretty close at today's prices. So when you look at the oil space, you have a huge amount of liquidity. So these offshore drillers have consolidated, and people will start to come back around. And so as the utilization rate of these rigs occurs in a higher fashion, which they already are, rates, because there's no more rigs, rates start to climb. And when rates climb, these offshore drillers make a lot of money. And regardless of how positive the results are in the wells. So it's a very interesting space. We like it long term, probably at least 3 years. And so we're a big fan of the space, and that's why we had a little research piece on it just a couple weeks ago.
It's amazing when you think about it, right? It's an industry that it's suffering. There's not a lot of interest. Oil's down. There's not a lot of interest in drilling offshore. Utilization rates go down. Supply gets cut. It's just so classic. Supply gets cut. Old rigs retire. There's not enough new ones. Utilization rates therefore increase and pricing goes up. And that's the cycle. And then you've got your wave of bankruptcies and everything clears the decks. It's amazing to me. I remember when I first got into the business, I could not understand for the first several years, and I can't put a timeline on it, but I would look at these cyclical industries and say, yeah, but history, doesn't repeat, but it rhymes. That I had been taught that. So why are people so freaked out about it, right? I was taught big growing businesses and they're meaningful. This is what the cycle is. And you can't understand, like, don't people learn? But thankfully, human nature is what human nature is. And they like to own what's working. And when something's left for dead, they want to forget about it. And it creates so many interesting opportunities. And that's how I feel about, like you do, on the offshore drillers. Any particular name that you like in the space?
We had mentioned Diamond Offshore specifically because we liked the situation they have. They have their parent company is a property and casualty insurer, and so
CNA,
they
right?
have a few other businesses. So we like that the fact.
CNA.
Yeah, absolutely, it's great. I mean, they have a good situation. So Diamond Offshore was kind of our safety play. And then our speculation play with Ensco. And Ensco just recently took the top spot for a publicly listed company that has the most rigs, and they've recently done some mergers there and acquisitions. And so we think that both of these companies will survive. So we kind of touched on the speculative side, and then we touched kind of on the safer side. And then, of course, Transocean remains to be quite a force. So all of those folks are pretty much pure play on the offshore drilling services side. And so those three we looked at. We recommended two of them, of course. And then in addition to that, another place, if you have a strong stomach, would be to look at the dry bulk shipping companies. They have also gotten wasted pretty much in the same fashion. Daily rates plummet. And so right now, the dry bulk side is also in consolidation. Prices are down. And so that's also a very interesting place to take a look at, too, which we did have a piece on that, I would say, about 2 months ago.
I want to shift gears. You just came out with a report, and it's interesting. It's something I normally don't pay attention to, but you called my attention to it about a week ago or so. You sent it to me, I think. And I want you to share what work you did. It's the report is called Beyond Borders. So what tell us about that? What's in there? What's your work on that?
Sure, absolutely. We developed over a period of a couple, I'd say actually 6 months, we had been developing this report. It's about 64 pages, and it covers the topic of internationalization and kind of a Plan B scenario. And it was targeted towards people that live in advanced kind of Western countries, specifically the U.S. Was targeted towards audience in the U.S. And it talks about diversifying globally. We talk about that, our view in the report, the view taken in the report was simply, folks want to have a backup plan, and they should have a backup plan in today's geopolitical environment. And so we discuss in the first bit of the report pretty heavily some issues, and probably pretty sensitive for some folks. And then we get into how you go about setting up your offshore global platform to be a global person. And we talk about, offshore bank accounts. We talk about filing requirements, which is very extensive, very burdensome filing requirements for U.S. people that live offshore. We talk about a little bit of foreign real estate, foreign business setup, residency opportunities. And then we talk about some kind of small little niche things that really make living, in different places throughout the year very simple and easy. And so there's some stuff in there that people are probably familiar with. And then there's a lot of stuff that people just have no clue about. And so we wanted to make a kind of a beginner's guide or intermediary guide to helping people set up that plan B for folks who want to have multi-jurisdictional risk allocation in different areas. So you don't have everything in one place, everything under one roof. You're kind of spread out and you have optionality. And so we covered that. And the report is available for folks, your listeners specifically. We just released the report this weekend, and folks can get that report at a 50% discount off our website, specifically for your readers and listeners. And so that's kind of what it entails. So don't go out and buy it unless you want to read this type of subject matter. If you're not interested in this, please don't buy it because there's no refund. So if you don't like the subject matter, don't read it. But if you do believe in a backup plan and having your risk spread across the globe, and you believe more of a global person, a global citizen, take a look at the report. It has very good information for folks who want to spread themselves out.
Great. Excellent. Yeah, I read it. It was I had not spent much of my time in the past focused on that. It was interesting. It's great. I really appreciate you taking the time. I always love talking to a fellow contrarian. And, as I think Adam Rodman, when he was on last week, he's like, we spend time scratching each other's proverbial back by telling each other that we're right, but when you're a contrarian, not many people tell you that you're right. So, you have to have the fortitude. When you find the rare bird who thinks like you, it's always great sharing thoughts and stuff like that.
Yeah, absolutely. Likewise, Mike. I appreciate your insights into the sectors. Some of the things that you're doing is quite impressive, and it's good to see a person like yourself going after it and helping out readers and listeners on your side understand the markets and certainly go after some of these contrarian areas. I think it's very, very a good place to be right now. I think that with the market situation, the big market, and some of the geopolitical issues that we have today, I think that folks need to take a look at some of these other things and be aware of what's going on. And I look forward to chatting with you, hopefully again. Oh yeah, because there's a number of things.
And my goal is to forge a new frontier in the newsletter side of the business, because the so many of the newsletters focus just on what's working today. And what's working today and what's really hot, and it drives me nuts. Stuff is, because if it's really hot and it's really working, I guess they go there because it might sell some more newsletters. But I was born and raised in this business to find value, and that's how I think about it. So.
I think we're going to hit another subject matter. Hopefully, in the next day or two, we're going to hit another subject matter that has to do with a market crash scenario and how that's going to apply to certain things. So we're actually going to cover that, which I wanted to talk to you about that. I hope to do that again in the future.
Love to have you back on the podcast, and I really appreciate you taking the time to spend talking with the listeners today. How do they get a hold of you, by the way?
For folks that need to get a hold of us, go to our website, smithweekly.com, all one word.
And weekly
very
being WEEKLY, right?
That is correct. Weekly, like weekly reports, absolutely, Or weekly spot price, if you will. So that's where you can find us. On there, of course, we have all of our services, most of which are typically free, the newsletters. So that's where you can find us. Just go to that website. You can also follow us on Twitter, which is also at Smith Weekly is the Twitter handle. So you can find us there to follow us. And then, of course, that nuclear report is available for your listeners specifically for free. And of course, we also have the discount for our other report for folks beyond borders, for folks who might have interest in that as well.
Great. Andrew, thank you.
I appreciate it, Mike.
Okay, well, I hope you enjoyed listening to Andrew. He has an interesting perspective, contrarian investor. So I always listen to contrarians. I like to hear what they have to say, and I love chatting with them. So for today, we talked about earnings seasons coming up. Hopefully, I gave you a few things to look at when you're listening to earnings calls or you are reading transcripts. Just some things to put in your mind, plant a seed for you to be thinking about. And I also wanted to put in your thought process the difference between what I view as generalists and specialists and the expertise that comes with it. So I hope you enjoyed it. I will be back the same time next week, and have a great week.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.